Dear students, I welcome you to my video lectures. I'm your course instructor, Dr. Mazullah Khan. Today is my second lecture on chapter number 17, in which we are learning how to prepare statement of cash flows. So for preparation of statement of cash flows, we need three pieces of information. Number one, we need comparative balance sheets. So for example, if you're preparing statement of cash flows for accounting year, let's say ending 2018, then you need a 2017 balance sheet as well. Okay, so we need comparative balance sheet. Then we need current income statement. So we need income statement of 2018, and then we need some additional information. These additional information may contain some off-balance sheet items which may impact the level of cash flows in our company. Three steps. In step number one, determine the net cash provided used by operating activities. So we are trying to determine the net cash flows from operating activities. And operating activities, mainly we are concerned about income statement items. Okay, this step involves analyzing not only the current year's income statement but also comparative balance sheets. But as I said, most of the items are coming from income statement. In step number two, what we are trying to do, we analyze changes in non-current assets and liability accounts and record as investing and financing activities. So the balance sheet items, the non-current assets, so the current assets are actually covered in operating activities, but the non-current part is actually covered in investing activities. The liability side of the balance sheet, it involves financing activities, and for financing activities, what we really mean that how does a certain company finance their different activities, or in other words, how do they raise their capital? Are they raising capital through debt, or are they raising capital through equity? This step involves analyzing comparative balance sheet data and selected additional information for their effects on cash. In step number three, we compare the net changes in cash on the statement of cash flows with change in the cash account reported on the balance sheet to make sure the amounts agree. So let's say if we have for 2017, let's say if the cash balance is let's say $1,000, okay, and then let's say the ending cash for 2018. So the ending cash for 2017 becomes the beginning cash for 2018, and let's say the ending cash for 2018 is $1,500. Okay, so the difference is $500. Once we calculate the net cash flows in step number one and step number two, it has to match with this number. Okay, so this gives us like a confirmation that whatever we did in step number two and step number one, we did it correctly. Indirect and direct methods. Okay, companies favor indirect method, and as I explained in my last lecture, they prefer indirect method for two reasons. Number one, it's easier to prepare and less costly. Okay, and it focuses on differences between net income and net cash flows from operating activities. In the coming few slides, we will learn how to calculate cash flows in step number one, which is operating activities, step number two, which is investing and financing activities, and then of course the easiest step is step number three, in which we get like a confirmation whether we are doing everything right or not. So what the indirect method does, suppose your sales revenue is $507,000, okay? These are the costs involved. So the cost of goods sold is 150, operating expenses 111, $9,000 is depreciation, and then the total expenses, including the interest expense, is 350. Okay, so the net income before taxes is $192,000. The income tax is $47,000, and your net income is $145,000. So this is our starting point. Okay, and then we have balance sheets for 2017 and 2016. So suppose we are preparing in this situation statement of cash flows for 2017. Okay, so we need balance sheet for the current year, which is 2017, and then we need a balance sheet for the previous year. Okay, our first task is actually to calculate the differences, and it's super easy. You plot all numbers for 2017 and you plot all numbers for 2016. Okay, and then in the third column you just calculate the difference. So the difference of 22 is actually the difference 55,000 minus 33,000. Okay, um, then we do exactly the same thing to the liability side. So we calculate differences. So the first thing, it was asset side of the balance sheet. This one is the liability side. Okay. Additional information, super important. So for example, depreciation expense was comprised $6,000 for building and $3,000 for equipment. Okay, so this piece of information is important because depreciation, as you can see, it's a non-cash expense. Okay, so calculating, whenever we are calculating the cash flows, we add back the depreciation expense because this one is non-cash. Although it's an expense, but it's non-cash. So that's why we have to add it back. Okay. The company sold equipment with a book value of $7,000. Okay. The cost was $8,000 less accumulated depreciation of $1,000. So the book value was $7,000 and the company sold it for $4,000. So there is a loss of $3,000. Okay. So this information is important. Issued $110,000 for long-term bonds in exchange for land. Okay, so the company purchased land, but instead of paying cash, what they did, they issued actually $110,000 worth of long-term bonds. Okay, a building costing $120,000 was purchased for cash. Equipment costing $25,000 was also purchased for cash. Issued common stock for $20,000 cash. The company declared and paid $29,000 as a cash dividend. So we need all this information because in one way or the other, they are affecting our cash. I mean, the net cash flows, whether it can be a cash outflow or maybe a cash inflow. So let's go to step number one. In step number one, what do we do? Determine the net cash provided by operating activities by converting net income from accrual basis to cash basis. Okay, so we do accounting on accrual basis. In this step, what we do, we convert the accrual basis actually to cash basis. Okay, so common adjustments that we do to the net income is we add back all non-cash expenses. Okay, so while calculating the net income, what do we do? We actually subtract the depreciation expense. But as I said, depreciation is a non-cash expense. Okay, it doesn't affect our cash position. So what do we need to do? We need to add it back. Okay, just to remove the effect of non-cash items. Deduct gains and add losses. Okay, so let's say these are the gains and losses on sale of assets. So for example, there's $3,000 worth of loss. We have to add it back. Okay, analyze changes in non-cash current assets and current liability accounts. Now, question for you: which is an example of a cash flow from an operating activity? Okay, the answer is very easy: payment of cash to lender for interest. So whenever you pay interest, okay, it's a balance. It's an income statement item, and as I said, the income statement actually belongs to operating activity. Okay, and of course, part of the balance sheet also belongs to operating activities. Receipt of cash from the sale of stock. This one is not, because capital stock is purely a balance sheet item. Payment of cash dividends to the company's stockholders. Dividend payable is actually a balance sheet item again, and none of the above. So this is actually the correct answer. Depreciation expense, as I said, we have to add this back. Okay, so if my net income was $145,000, okay, it means that I already subtracted depreciation. So this 145 is what we call net of all expenses. Okay, so it means that I have already taken out depreciation expense. But as I said, depreciation is a non-cash expense, which means that I have to add it back. Okay, so the net cash provided by operating activities is $54,000. Okay, loss on disposal of equipment. Companies report as a source of cash in the investing activities section the actual amount of cash received from the sale. Any loss or disposal is added back to the net income. Okay, so loss is added back to the net income. Okay, and gain. Okay, this is just like a depreciation. So the treatment that we do for depreciation, we do exactly the same treatment for loss. Okay, and then of course gain is deducted. Okay, so in this situation, in this our example, net income reported on the income statement was 145. We added back the $9,000 depreciation expense, and then we added the $3,000 loss on sale of equipment. Okay, so my total now is $157,000. Okay, now changes to non-cash current assets. Now changes in current assets, again, it's an operating activity because current assets are composed of, let's say, inventory, for example. Okay, so inventory belongs to operations of the company. Okay, so it actually belongs to operating activities. So when the account receivable balance sheet decreases, cash receipts are higher than the revenue earned under the accrual basis. Okay, so forget about this statement for now. Okay, now, for example, at the beginning of the year, my account receivables were $30,000. Okay, I sold some items. Okay, and my sales figure for the 2017 was $507,000. We received $517,000 from customers. Okay, so my net balance of $20,000 is actually what it is affecting my cash flows. Okay, so when the account receivable balance decreases, okay, so my account receivable balance initially was $30,000, but now it's only $20,000. Okay, so what does it mean? Cash receipts are higher than the revenue earned under the accrual basis. Okay, so the cash receipts are higher. So this one has a positive impact of cash inflow. So company adds net income to the amount of the decreases in the account receivable. Okay, so I will actually add the decrease in account receivable. Okay, so again, let me give you another simple example. So for example, my account receivable at the beginning of the year was $20, but now it's only $10. Okay, so the difference is $10. It means that I already received the difference between the two as cash. So I converted my account receivables to cash. And by how much? By $10, by the difference. Okay. Changes to non-cash current assets. When the inventory balance increases, the cost of merchandise purchase exceeds the cost of goods sold. Okay, example again. Suppose at the beginning of the year, okay, at the beginning of the year, I had $10,000 in inventory. Okay, of course I made some purchases. Okay, and then my cost of goods sold was $155,000. Okay, and my balance is $15,000 now. Okay, at the end of the year. Okay, so what happened actually? My inventory increased. Okay, so if your inventory increases, okay, of course, in order to increase the inventory, you spend cash on it. Okay, inventory does not increase in vacuum. Of course, you have to buy it, and once you buy it, of course, you spend cash on it. Okay, so cost of goods sold does not reflect cash payments made for the merchandise. The company deducts the net income. This inventory increases. Okay, so your cash actually decreased by $5,000. Okay, and the reason it decreased because the inventory level increased. So we can get this number from 2016 balance sheet, and this number we can get actually from 2017 balance sheet. Okay, so this is like, for example, this is the ending balance of inventory for 2016. The ending balance becomes the beginning balance for 2017, and this is the ending balance for 2017. Okay, so that's why we have to deduct it. Now, changes in non-cash current assets. When the prepaid expenses, so prepaid expense is an asset. Okay, so you paid expenses in advance. Okay, and you did not get any services for those expenses yet. So these are your assets. When the prepaid expenses balance increases, cash paid for expenses is higher than expenses reported on accrual basis. The company deducts the decrease from the net income to arrive at the net cash provided by the operating activities. Okay, and I'll give you some numbers and then you can easily understand it. If prepaid expenses decreases, reported expenses are higher than the expenses paid. So increase in prepaid expenses is $4,000. Okay, it's a prepaid expense. Expense is an outflow. Okay, so if your prepaid expenses is on the rise, if there is an increase, it means that $4,000 actually it's a now cash outflow because your prepaid expenses increased by $4,000. And as I said, prepaid expenses is an outflow. That's why it is in parentheses. Okay, so you have to subtract it. Okay, so my net cash provided by operating activities now reduced to $158,000. Okay, so 145, we have to add these three items and then we have to subtract these two items. Now, changes in current liabilities. Okay, when accounts payable increases, the company received more in goods than it actually paid for. The increase is added to the net income. Okay, so if my liability increases, okay, how does my liability increase? So suppose I have $10 liability and now my liability is $50. Of course, if my liability increased by $40, it means that it's a cash inflow transaction. Okay, it has a cash inflow effect. Okay, so my liability increases only if there is an inflow effect of cash. Okay, so whenever my loans, my debts increases, of course, an equivalent amount of that, I'm getting that actually, okay, from my current liabilities. Okay, in other words, if my current liabilities are increasing, it has an inflow effect on cash. Okay, so for example, decrease in accounts payable is $16,000, so I have to add it because it's a increase in accounts payable. Okay, so initially my accounts payable, as I said, suppose if it was $10 and now my account payable actually jumped by $40 and now it's 50, it means that the accounts payable, this positive number, it's a cash inflow. Okay, decrease in income taxes payable, of course, it's a liability again, and if it decreases, it means that you paid your liabilities out, and once you pay out your liabilities, it's a cash outflow activity. Okay, so everything, if you analyze it properly, systematically, super easy. There is no rocket science into it. Okay, so increase in liability, it's a cash inflow. Decrease in liability, it's a cash outflow. Okay, this gives you like a quick cheat sheet. Okay, So depreciation expense, I have to add it. Okay. Amortization expense, I have to add it. Depletion, I have to add it. Amortization, depletion, depreciation, different terms used for different assets. Okay. Depletion actually we use for natural resources. Amortization for intangibles. Okay. Depreciation for physical assets. Okay. Gains and losses. Losses are added back. Gains are deducted. Okay. Increase in current assets is deducted. Decrease in current assets is added. Increase in current liability is added, and liability is actually decrease in liability is deducted. Once you understand actually only one part, okay, the remaining you have to just reverse it. Okay, so increase, if it's a decrease, you have to reverse the sign. Okay, and for asset and liability it will be reversed again. So for assets if it's minus, for liability it will be plus. Okay, for asset if it's plus, for liability it will be minus. So super easy again. Once you get hold of one, okay, all three others they're easy to compare, I mean, and then assign a different sign. Okay, now let's do an example. Josh reported net income of $73,000 for 2017. So this is net income for 2017. Included in the income statement were depreciation expenses of $7,000. So this is depreciation expense, and a gain of disposal of assets. So this is gain. So it will be deducted. Okay. Josh comparative balance sheet show the following balances. Okay. So account receivable is $17,000, and these are balances for 2016 and 2017. Okay. Accounts payable 6,000 and 2,200. Calculate the net cash flow provided by operating activities for Josh. Super easy. Okay, so what do? We start with our net income, which is $73,000. Okay, what do we do then? We have depreciation expense of $7,000. We have gain of 2,500, and as I said, gain is minus. Depreciation is added back. Okay, increase in accounts receivable is minus, and decrease in account payable is minus again. Okay, so my total is $3,300. So my net would be around $69,700. So it's a difference between this number and this number. Okay, and I hope it's easier for you to analyze these statements. Why is like depreciation added, and why is, let's say, gain on disposal of equipment is subtracted. Okay, company purchased land of $110,000 by issuing long-term bonds. Okay, this is a significant non-cash investing and financing activity that merits disclosure in a separate schedule. Okay, so let's say this is your T account. Okay, your balance, so your starting balance was $20,000, but you bought another piece of land for $110,000. Now your new balance for land is $130,000. Okay, the bonds payable, which is your liability, initially the balance was $20,000, and now for land you issued another $110,000, so the balance is $130,000. Okay, so partial statement, how do you do that? Net cash flows provided by operating activities is 172. So again, it's coming from the balance sheet. Sorry, we calculated this number. Okay, and let me take you back. Okay, this is the number. Okay. Okay, so this is the number 172. Okay, so we already calculated the operating part. Okay, and there are some other investing and financing activities. So cash flow from investing activities we purchased a building. Okay, so when we purchase a building, of course, it's a cash flow outflow activity. So I bought building, and then of course I paid for it. So it's a cash outflow. Okay, purchase of equipment, against cash outflow. Okay, sale of equipment. So if I sell something, of course I get cash. Okay, so it's a cash inflow activity. So net cash used by investing activities. Okay, so investing activities relates to the asset side of balance sheet. Asset side of balance sheet, but only the long-term assets, not the current assets. Okay. Now, cash flow from financing activities. Now, financing activities, it's actually the liability side of balance sheet, and of course the long-term liability side. Okay. So the issuance of common stocks, $20,000. It's a cash inflow activity. Now, payment of cash dividend. Okay. It's $29,000. It's a cash outflow activity. Okay, so net cash used by financing activities is minus $9,000. Net increase in cash is 22. Where is this number coming from? So we have balances for cash for 2016, and then we have balances for cash for 2017. So that is the difference between those two numbers, this number and this number. Cash at the beginning of the period was $33,000, and cash at the end of the period is $55,000. Okay, and this $110,000 is actually coming from the disclosure. So this is like an off-balance sheet item. Okay, so this was issuance of bonds. Okay, to purchase land, which is $110,000. Okay, from the additional information, again, off-balance sheet item. The company acquired an office building for $120,000 cash. Okay. Okay. Sorry, this is not a balance sheet item, but this not off balance sheet, but actually this gives us additional information. Okay. So this is the cash outflow reported in investing section. Okay. So for example, T account for building, again, the balance was $40,000, but we bought another office building for $120,000. So now my balance is $160,000. Okay, so all numbers exactly the same. Okay, issuance of bonds on purchase of land is $110,000. Okay, but what did we do? This is actually the number which is coming from this line, $120,000. Okay, so this is the building that we purchased. Okay, so that's why we added it here. The additional information explains that the equipment increase resulted from two transactions. One, purchase of equipment of $25,000, and then sale of $4,000 of equipment costing $8,000. So there is a loss. So we sold something for $4,000, and the book value was actually, the costing was like $8,000. So I would assume, okay, and depreciation actually is here is $1,000. Okay, so the cost was $8,000. Depreciation was $1,000. So the net book value is actually $7,000, and we sold it for $4,000. So there is a loss of $3,000. Okay, so cost was $8,000, which is here. Okay, less accumulated depreciation was $1,000. Okay, so the book value was $7,000, and then we sold it for $4,000. Okay, so that's why there was a loss of $3,000. Okay, so beginning balance was $10,000. We purchased equipment for $25,000, so my total balance was $27,000. But I sold an equipment for $8,000 as well. Okay, so that's why there is a loss on disposal of equipment of $3,000. So I have to add it back. Okay, and we already know how did we calculate this number. Okay, purchase of building is $120,000, purchase of equipment is minus $25,000, and sale of equipment is $4,000. Okay, now investing in financing activities, the increase in common stock resulted from the issuance of new shares. Okay, so balance was $50,000, then we sold another $20,000 worth of shares. So now the new balance is $70,000. So this is a cash inflow activity. okay, and we can see it here. Okay, and I will actually summarize all those numbers in one slide. Then they will be very easy actually to understand. Okay, retained earnings increased by $116,000 during the year. This increase can be explained by two factors: net income of 145, okay, and number two, dividends of $29 decrease the retained earnings. Okay, so the balance was $48,000. Okay, there was a net income of 145, so which means that I have a balance of 164, out of which we paid actually a dividend of $29,000. So the difference, which is here, the cash dividends, is $29,000. Okay, and $145,000 is already appearing here. Now, question for you: which is an example of a cash flow from an investing activity? Okay, and the answer is this one: receipt of cash from the sale of equipment. Okay, and as I said, investing okay, so cash flows from investing activities, they relate to the asset side of balance sheet, but the long-term assets. Okay, so only this option actually satisfies this condition. Okay, this is the last step. Okay, so in step number 3, what do? We actually confirm whether whatever we calculated, we did it right. Okay, so again, this is balance sheet for this computer services company. Okay, their beginning cash, like for 2016, the ending cash was $33,000, and for 2017, the cash balance was 55. Okay, so if you go back, okay, the ending cash is $55,000. So this cash matches actually the the cash balance of 2017, and this net cash increase is actually the difference between the two cashes, okay, which is here. So $22,000 is the difference, and this $55,000 is the new cash balance. Okay, so this exercise, this step means that okay, whatever we did it right. Okay, I will stop here, and in my next lecture I will move on to learning objective number 3. This exercise is super simple, although you will feel little bit overwhelmed by lots of numbers, but at the end of the day it's super easy. Okay, you go step by step. In step number 1, what you do, you tackle actually only the operating activities, so income statement items and the short-term assets, short-term liabilities. Okay, and what do you do for balance sheet items? Actually, you are working with differences. Okay, so you take 2016 and 2017 and find out the difference. Okay, and then you try to critically think about those differences, whether those differences will affect the cash will it be like a cash inflow or will it be a cash outflow item? Okay, and step number 2, what do? You are only concerned about investing activities, and you are also concerned about financing activities. Okay, and while doing so, you are considering actually the additional items on the balance sheet. Okay, and additional items, additional information, in fact, gives you, as the name suggests, more information to establish whether a certain transaction resulted in a cash inflow or a cash outflow. Okay, for example, increase in buildings. Let's say if those buildings were acquired by issuance of, let's say, debt security bonds, okay, it did not affect any cash, okay, because we did not bought those buildings, let's say, against cash. In fact, we bought them against bonds. Okay, so we have to dig out further through additional information to find out whether it was a cash inflow or a cash outflow. Okay, in step number 3, what do? Whatever we calculated, for example, here, okay, here, okay, so these two numbers, number 1 here, Okay, and number 2, this one. Okay, we have to see whether we calculated it correctly. Okay, and as we can see, we calculated it correctly. Okay, so I'll stop here, and in my next lecture I will tackle learning objective number 3. If you have any questions, please drop me an email, and you have also my WhatsApp number, so you can contact me through email or WhatsApp. I wish you all the best for your exams, and I'll see you soon. Have a wonderful day.